Saturday, you petulant crypto incels. Hope everyone's having a great weekend. Today we're going to look at ETH and a 6-step process I use to get into fade entries. We'll start with ultra high time frame just because ETH has more data, so we're going to use the monthly chart. In this case, we took out this external high right here and then drew into the monthly imbalance down there, filled more than half, and then drew up into deep premium within this stealing range. So if we drop the time frame, you could see that this high got taken out by that high. So our monthly draw was up here, our weekly took out the external and then drew into the middle of this stealing range, the deepest inefficiency right there, got a strong wick, shows us a lot of buyer intent and absorption in the range. So after hitting the internal imbalance, you're looking at the external. So monthly and weekly are aligned. And then what I normally do on the weekly, I try to time frame align and look for structure on the 4-hour time frame. So keeping the weekly imbalance on our chart here, it was completely rebalanced, and then we had this automatic reaction coming out of the range from this low to that high. So that's defining our dealing range for the 4-hour. So if we use a fib, a lot of you guys have seen me use this before, 618 to 786. It's called the optimal trade entry fib, and we anchor it to the low and the high, and we're looking for a cluster to form inside of that range. That cluster should take out internal liquidity like it did right here. So that's our internal 4-hour raid. The high that formed before the raid of the internal range, you want to see a shift above that, which we have over here. So now we have all the elements on the 4-hour chart to look for a swing long entry. So optimal trade entry, raid, shift. Now we have a new dealing range. Some people measure it from this low that took out the internal low here. I use it at the most recent raid or swing low. So you can see there was a internal range here. These two lows got stopped out over here. So I'm defining my dealing range from that low to above the shift, wherever the move ends up stopping. So assuming this is the high, this is the current dealing range. And we only want to be, if our high time frame bias is up on the weekly, monthly, daily, we want to let price on the intraday come back into discount to look for longs. So I'm only looking at longs at this point. Anything in between, I'm just scalping short. So below this equilibrium in the dealing range here, we want to see where in this general area do we have a setup. All right, so now we got our high time frame and our intraday. What I'll do is look for structure. So because it was a weekly key level we hit, that weekly imbalance right there, this is our range on the weekly dealing range. So a new one that formed from here to here. And I want to see structure developed within that range. So weekly is time frame aligned with 4-hour, but if it takes a longer time for a structure to develop within that weekly range, sometimes it's easier to visualize it on twice the time frame. So 4-hour, I would just map it to the 8 instead. So if you look at the 8-hour, we have a raid of this high over here, and then above those highs we get order pairing. That's where your sell program activates. It's confirmed after the shift from the wick that formed the final high. Inside of this dealing range, we have our low risk sell, which is effectively this below equilibrium of this dealing range. There's a bunch of internal highs that form and they get raided, and then a big displacement down that eventually leads to a shift. So this was our low risk sell, which is usually at the top of our market maker models, and then we see structure develop. So below the shift, we have this first consolidation range, second consolidation range, so it's a redistribution. Buy program is activated inside and below that weekly internal inefficiency. You can also pop it into the daily, and if there's a massive daily wick, on a pullback, I look for a mid-wick fill. So your low risk buy, which ended up being in that 4-hour cluster, the OTE cluster, that took out the internal lows right here, also was around the middle of the wick fill. So that's something, when you have a really strong buy wick, usually half gets filled because there is some inefficiency on lower time frames there. So this ends up being your low risk buy basically in there. And then you could see we're in our first phase, consolidation. So what we are identifying in this range was the 4-hour shift. So now if we just put our 4-hour map on top of that, there was the internal lows getting nuked into that cluster, which was our low risk buy. So raid, shift, and now in the dealing range, we're basically in the consolidation range. We want to see, this looks like exhaustion up here. It might do one more push up to grab that high, but the point is we want to see the range form and just test the lows again. So that's pretty much where I believe we are on this model. And you see it on multiple time frames. So that was the 4-hour. If we go in the 3-day, we have a very similar print that we can map to time frame align on the 2-hour. So this is your deepest discount inefficiency right there. So our 3-day target is going to be the external high within this final fractal over here. If we align the time frame, so if we use 4-hour structure for the weekly key levels on the 3-day, which is about half of the weekly time, we would use half the time frame for the structure, which would be 2 hours. And you can see it here. We have a very clean 2-hour market maker model. So these highs get nuked over here, sell program activated, big push down, shifting structure below these lows, distribution 1, distribution 2, buy program activated inside of that, inside and below that weekly target. Here's our low risk buy. Within this dealing range, there's a fair value gap or inefficiency here. It gets filled. Even if you drag this across, you could see they use it as support again here. And then it forms this 2-hour consolidation range. Now, if you see what it did here at the lows, this is very interesting. I talk about this a lot. This right here was your consolidation purge, which you don't always see in that first consolidation zone. It usually happens on the reaccumulation, which is the next level up. But yeah, you did have one here on the low time frame, and usually that precedes expansion, where you leave the zone and you target the previous sell side liquidity, which is this, and this. Sorry, this is buy side liquidity. And right now we're in a 2-hour consolidation range. So what I'm anticipating in the range is the same thing we identified here, a consolidation purge of this range. And it looks the same whether you're on the 2-hour or 4-hour. Basically, they're both more or less the same market maker model. So now we'll get into the actual setup and this fractal right here, because even though I'm long on high time frame, because the weekly, monthly, and all high time frames are biased to go up, I just want to see the intraday bias realign with the high time frame, meaning I need to pull back into discount in order for the next magnet to be up here for 4-hour. So this is the fractal we're looking at, and that's our dealing range, basically all this. All right, so let's look at it. What do we see here? Well, this is a range. It's ascending with higher lows. So there's a lot of liquidity being engineered in this range. And within this fractal right here, I could see various consolidation ranges. So if you map it like this, you have a raid, original consolidation here, first level accumulation, reaccumulation, push up to take the 4-hour high. All the stops get triggered, and offers, resting offers get filled, and then you start forming this zone, this one right here. It could all be one zone, and you might purge these highs, or you might just get to like this level. We'll have to see how this plays out, but within this range, which is part of the 4-hour market maker model, we're looking at a intraday or 4-hour consolidation range, and what we're trying to play is the scalp within the range from this high to that low. So this is what we're looking at. So step one, let me just get this off. Step one, you can see there was a daily imbalance above here, and there was an external high. So if we zoom out to the daily, within this dealing range high to dealing range low, this is premium, and you could see the highest inefficiency within premium is up here. This was rebalanced in retime half on the way down, so this would be a logical draw. We tagged the bottom of it here. We didn't fill half, so that's kind of a footprint to everyone that we're probably going to raid this high again and at least rebalance on high time frame, daily, and 4-hour more than half of that imbalance, which we did now. So now we have a 4-hour raid into a daily imbalance, and our bias now shifts to this fractal, and we look for where the trade is. So step one, my bias is down here. After we hit this high time frame key level, I'm looking to draw into this 4-hour imbalance right here, or this weekly imbalance right here. They're both pretty much in the same range. So step two is the top of the fractal. This part's a little esoteric, but I'll just show you why I took the trade. So we hit the high time frame key level, and that last push up was pretty manipulative. I took this trade. If you drop the time frame, or even on this one, you could see a 15-minute imbalance here. If things are bullish, when it pulls back, it should respect this imbalance and use it to support price action higher. I usually use the 5-minute time frame on a 15-minute structure. So here's your last imbalance. It gets closed below, so that becomes an inversion or an inverse inefficiency, where it should act as resistance when we pull back. And you can see we hit it 1, 2, multiple times here, 3, 4, and then reject and go lower. Aside from that, there's two other arrays within this fractal over here to pay attention to. You have a breakaway gap here. The way to identify a breakaway gap is if this 5-minute inefficiency gets disrespected and closed below, you look at the two candles that led that move below this breakaway gap. You can see a push down with a wick here. The next candle wicks up to rebalance this zone and then closes through this wick. So now this zone right here is rebalanced, and it's called a balanced price ratio. So what you do is essentially from this candle low to this candle high, everything in that zone is considered balanced or fair price. It's already been tagged here, and anytime price goes into that, you're expected to not reach into the breakaway gap. It can, because it's crypto, and crypto is more volatile than equities and indices, but you look for first interactions to treat this as resistance, which it did. So I got in the trade when we got this first tap in here. And then eventually buyers gave up and it pushed down, made a nice low. Now we're kind of retracing a bit, but that's step two. So high time frame area of interest, reaction the way you wanted it to be. Then you flip it into low time frame and just read the first dealing range. What type of levels are supposed to be respected to continue order flow to the upside, and the ones that are being disrespected are hinting that this might be now switching into low time frame sell program. So that was step two. Step three, I usually map where the structure is within the range, and where the volume is in the range. So let me just hide this for a minute. If you just visualize this right here, this is where supply came in, right? So you can see very strong sell wicks here, and then a big push up. This was the manipulation on Friday. So after it manipulated, it rebalanced the daily candle and then closed right back below structure, right? So this is considered a deviation or a manipulative move. And now this is defined as structure. So what you want to see is every interaction with it gets sold off. Some of them do false bullish breakouts, but then they deviate again and come back under until the last bit of buy pressure is absorbed by supply and then pushes down, breaking structure that led to the high. So this last low that led to that manipulative high is the level you want to see price shift and close below, which we do right here. And then that's an early signal in step 3 that we might be in the sell side or sell program, and we're just looking for shorts now. So that's your shift. Even on the 15-minute time frame, very obvious. So then we go into step 4. After that first drop, defining the dealing range from that high to that low, you want to see, are they engineering liquidity? I find within the market maker model, they'll do this a lot, where people will treat this as an order block, which it is until it isn't. And as of now, if you just kind of visualize it, this is where it's catching bids 1, 2, 3. So as of now, they're protecting it like a bullish order block. But what it's actually doing is it's engineering liquidity for the move down. Because if you understand how these fractals work, high time frame is drawing into the 4-hour low. 15-minute time frame is engineering liquidity for that move down to the low. So these are all failed swings, meaning none of the, like in ascending order, these wicks didn't take out that low. This wick didn't take that low, and they're basically all open liquidity. So that's a very nice footprint when you're looking at how market maker is engineering liquidity for the move down. Also want to identify where the imbalances are or the inefficiencies within this dealing range. So you have on the sell side, sorry, on the buy side, you have one inefficiency here. These were all rebalanced in real time. This is another inefficiency here. So I want to make sure, because that could be an area to draw to. So that's step 4. Step 5, within the new defined dealing range, high and low, this is equilibrium, this is premium. If you're bearish, you want to see what price does when it goes into premium. In this case, what I see as a target would be this liquidity. You have relatively equal highs and very low resistance. So this would be kind of a setup for low resistance liquidity run. And they could even take out the Friday high. So it's all an option. But for now, this is the top of the dealing range. That's the low. This is in premium, which would be a pretty decent target. So what I would look for is something like this, a grind up, a strong deviation wick, and then underside retest to start the move down. And then I would be shorting potentially over there, depending on the price action. But yeah, the next step 5 was basically defining the local dealing range. And in premium, if you're bearish, what is a reasonable target, which is going to be these highs. So that's step 5. And the last step, step 6, this one's a little esoteric. So these red boxes, these are high volume nodes in a point of interest. So basically a point of interest is an area where an order block might have formed and it has high volume supporting the order block. So within the order block, let's say this is your order block. There'll be a certain volume distribution here, 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 here. And this right here, this cluster of volume is your high volume node. It's where the most people will trade the asset, whether they're buying or selling. It just has the most volume in that range. So if we zoom out, I'm looking at the last high before market started to go into a sell program. Where was the final range before it started to displace lower? So I would take not the impulse candle up, because that kind of skews your volume range, but I'll take the first, smaller candle right here that defines the beginning of the range to where we left the range. So basically it was using the value area low as support here, 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 here. And then here we started to close below and retest it as resistance. And you can see when it retests the value area low and it rejects, then it expanded and made new lows and started to form a new distribution zone until this value area got deviated and rejected, and it continued the move down. So within that first zone, where basically the original supply came in, I want to see where the volume was traded. And the histogram here is very clean. It's all right here around the point of control. So this is for this session. This was the high volume node and the area of interest within that final area of supply before dropping down. The next session here before a drop, you can see there's one more cluster right here that back tested the value area low of the previous session. And then once it deviated below this high volume node, big move down, forming a new range. So below, just above where price was on ETH, where I was starting to consider a fade, I wanted to know the next 2 points of interest. Where's the volume traded within my area of interest? And those were them. So if we just go back to the chart, you can see it hit the first high volume node right here and rejected. So the first area of interest ended up being the one that they took and immediately started to pull back. One more thing I do on this step 6, I look for if the full weekly imbalance hasn't been filled, how close is my next point of interest? And in this case, I measure from the wick where we're at the current area high or session high or whatever. And where's the next point of interest, which is right here. It's only 1% away. So if I'm trying to frame the low time frame short, and in step 5, this right here is my area of interest. I want to see that get flushed and then underside retest and more down. If it starts, say it flushes it, but then it starts building and trying to use it as support, then I'm assuming they're going into my next point of interest. And I want to treat this as an area where I look for the short. So that's the point. Like, you can't be rigid thinking, okay, I only have one plan. If it goes in here and rejects, then that's it. I'm good. I just enter the trade and down. What if it doesn't, right? And you're not prepared? Like, do you even have a stop or an area of invalidation? If it does start building above here, where's your next area you're interested in fading? Because it's not going to go from the range highs straight to the new level. There's always going to be pullbacks, right? And you want to position for a potential scalp short if you're trading. But yeah, that's the whole idea, and my 6-step process, the way I try to enter a short. There's a lot more to how to enter the short in the range. I'm not going to go into everything in this video, but this is a pretty good sample of what I do. So hopefully you guys get some value from this. Leave comments below, troll me, reply guy me. I have people telling me my music's too loud. It's kind of tempting me to make it even twice as loud on this one. Let's see how I feel when I'm actually publishing it. All right, reply guys, see you in the chat.